Hey everybody, welcome back. It's Ben Morales, your personal financial coach, and I have a question. Have you ever found yourself in so much credit card debt that you're absolutely losing your mind when you look at that statement? What it does, it creates so much pressure on you, right? It's the first thing that you think about when you wake up in the morning, and it's the last thing, unfortunately, that you think about when you go to bed. I've been there before as well. Thankfully, I've learned these systems, I learned these tricks, I learned these hacks, whatever you might want to call them, and now I have my cash flow working for me instead of working for the lenders and banking institutions. So I want to share with you today is how do you make the decision when you find yourself in that position? What credit card debt are you going to tackle first? That's such an important question because you don't want to start a strategy like this rapid payoff method, use it incorrectly, and then what it does, it actually negatively impacts you or it delays the time that you could potentially pay off your credit. So you want to use it in the right way so that way you do this process the most quickest and the most efficient as possible. So how do we figure that out? Well, I want to show you a client that I'm working with today. And these are the credit card debts, and these are the loan debt that this client has. There's a total of $29,853.73 in debt. Most of it, as I mentioned, is in credit cards. So how do we alleviate this pressure, right? All this pressure of having to pay these credit card debts, I can only make the minimum payments because all my other cash flow is going other places as well, all the other responsibilities, including trying to save to buy a home one day, right? So let's start changing this up. Most people, what they'll do is they'll go to a bank. And I remember this would be the case when I worked at the bank. A client came in, they found themselves in this position, and they're looking to alleviate that pressure, and they want to get a loan. Now, that is potentially a solution, right? You can go and get a personal loan, even though less and less banks today are offering personal loans, but that could be a possible solution. You get a loan. However, the main issue with getting a loan is that you restart and you start to calculate the interest or the upfront cost of that loan as soon as you get that loan. So we want to avoid that because you want to have leverage. Leverage is the name of the game. So rather than doing that and focusing on just the payments and focusing on just the alleviation of the actual debt, let's look at strategically how we're going to pay this first so that way our cash flow is working to our advantage as much as possible. Well, here's what I've done. I've listed the interest rates of the credit card debt. Now, usually there's very popular credit card payoff systems out there. You may know them as the debt snowball. You may know them as the debt avalanche. So that's when they look at one or two pieces. They look at either the balances or they look at the interest rate. And based upon which strategy you want to try, that's what you implement. Well, I want to introduce to you, maybe you've heard of it or not, but there's also another method which is called the cash flow index. And the cash flow index, remember, cash is king. What that does, it tells you in comparison to what your balance is, how efficient is your cash flow? Is it at paying off debt? So, for example, this bottom one here, this is a $104 balance that owe $104.73, and the payment is actually $30 a month. So when we look at the score, right, all I did is I divided 104.73 by 30, and I got a score of 3. That is how effective that cash flow is at paying off that debt. So with this cash flow index, anything that is between a 0 and a 50 is in red for a reason, right? So none of her debt is efficient, none at all, with the exception of this credit card here, which is at 0%. That was actually at 97. So anything between 0 and 50 is inefficient. Anything between 51 and in this case 99 is going to be, let's call it yellow. It could be orange, right? But anything over 100 and over is actually an efficient cash flow managed debt. And that's where we want to get when it comes to our debt. So these numbers here that I've written to the right, that's going to tell us, based upon our cash flow index score, how we should tackle that debt. Which one goes first? Which one goes second? Which one goes third, fourth, fifth, and so on and so forth. Now, the only ones that I changed, and I'll explain this in the middle, was these two. They're very close to each other, but the cycle and how we're going to pay it off is going to make sense. So let's look at the debt tool, right? In this channel, I teach don't use loans. What we're going to focus on is using a personal line of credit because it has a revolving aspect to it, which means you can use it when you use it and make the payment. And if the payment gets applied to that line of credit, the same amount of money that you use becomes available for you once again. And you can't do that with a loan. That's why we don't want to do a loan. But let's strategize this the correct way. Let's strategize this the responsible way. If she got a personal line of credit at 9%, with her credit score should be more or less there, and she leveraged $15,000 personal line of credit. Our target is going to be 66%. So what that means is we want to stay as much as possible only at a utilization rate of 66% of the amount of the personal line of credit, which 66% of that is $9,900. There's some wiggle room, but for the most part, that's where we want to be at. And that will help us actually calculate how much this strategy will cost us in terms of interest costs, and that's $75.64. So now we know, okay, let's start looking at all the debt that we have. So here's the debt in credit cards. Now we're going to go up to $9,900. We're going to try to fit in as much as possible of this credit card debt into that line of credit and into our target number of 9,900. This is how that looks. So we're going to go with the 104 because that's number one. We're also going to pay off the 120. We're also going to pay off the 450. What else we got here? Number 4 is 820. Number 5, where are you at? 5 is actually 2030. Number 6 is 2100. And number 7 is 2300. When we add all of that credit card debt off, it comes out to $7,724. But we're trying to reach that max of 9,900. So we have a little bit of a wiggle room. So what we're going to do is, because we still have $7,724, we're going to bump up $2,000, and we're going to start to chunk away at this one as well. So let's mark them off. We have this one, we have this one, we have this one, this one, this one, this one, this one, and we have 2,000 of this one. All right. So we owe $4,700 here, but in order to get to that 9,900 maximum, we can take 2,000 from this debt and eliminate that as well, right? So that means that our payment is going to go down probably to like $80 instead of $121. So now we're going to have an increase into our cash flow as well. So we got all of these 1, 2, 3, 4, 5, 6, 7, and this one's 8. Now what we're doing is we're taking this $15,000 personal line of credit. We've moved all the credit card debt, right, including this $2,000, into that personal line of credit. The personal line of credit has an interest rate of 9%. But look at, would you rather pay 9% or 29, 28, right, 27, 28, 27, 27, 32? That's a no-brainer, right? Let's move all that horrible debt. Let's improve our cash flow, right? And let's start paying off debt. So now, something else that the line of credit will give her the ability to do that her current structure does not, is that she can use her line of credit as if it were a checking account. So what that means is, instead of paying a $75.64 payment for the line of credit of $9,900 every month, she's going to move the entirety of her income into the line of credit. And that's what's showing up here. I wrote it out for you so you can follow along, but it's $3,275 in the income it's going in. That $3,275 is considered payments. So instead of one payment, well, that's way more than one payment, right? So all that income is going in there is considered a payment. And because it's revolving, because it's a line of credit, she can take the money out once again when she needs it for her bills and for her daily living expenses as well. So here's what's happening as well. We started the beginning of the month. We know here her expenses were $2,774.69. But when we eliminated all this credit card debt, including a portion of this Navy Federal, that freed up cash flow that's no longer payments for her. So if they're no longer payments, what's happening? Well, she's starting at $2,774.69. We made space, excuse me, we made space and created an additional $433. Where did it come from? From all these payments that she no longer has to make. So if we know that we created $433 in extra cash flow, that means that her expenses is also going down. And that's what you're seeing here. Excuse me again. The expenses are no longer $2774.69. They're actually $2341.69. That's amazing. And this is the value and the good thing about using a personal line of credit. She can put all her income there. These are her expenses, but you can see her cash flow now has gone up by the same dollar amount, $933.31. What does that mean? I need you to realize and understand. That means that every payment that is being made when she puts her income in throughout the course of the month, there's actually $933.31 of cash flows that impacting the balance of this particular line of credit where she started with. You can see that that's what's happening here, right? You can see it again in month number 2. You can see it again in month number 3. You can see it again in month number 4. Now, here's the interesting thing, because something happens at the end of month number 4. At the end of month number 4, there's a balance left in that personal line of credit of $6,455.08. So now we take a pause there. Because we're leveraging this personal line of credit like it's a checking account, and we have the ability to go use that money, pay it, and then use it again, that means that we can now move another portion of debt into that personal line of credit. So at the end of 4 months, she owed $6,455.08, and now we can actually go back to this Navy Federal, which we were paying, right? We were making the minimum payments. Let's say it was about $80, right? Because we took $2,000 of it. We started with $2,000. We moved it into the personal line of credit. So now our payment was less, right? Our expenses dropped. But by the time we got here, we're probably going to have a balance left in the Navy Federal credit card of about $2,500, and that's what we're doing. We're actually moving it into the line of credit. So what's happening, right? That means something else is happening on the back end. If we, at that point, our expenses were $2,341.69, and now we do not have that $80 payment to the Navy Federal, that means what? Our expenses are going down. So our expenses are going down to $2,261.69. What does that mean on the cash flow side? Beautiful. Our cash flow is going up. Our cash flow has now gone up to $1,013.31. You see how this works, guys? Whatever's happening on the expense side is going down, is actually impacting the cash flow side. So what does that mean? Here's our new expense category, right? So our balance, we moved over Navy Federal. That one is completely eliminated now. No more balance left. We only have now 2 more credit cards to work with. This one we're really not worried about too much because this one has 0% interest for another 16 months. So good to hear that. But in the meantime, we're going to focus next on getting that Discover in there. But let's follow the cycle again. $3,275 in income. The expenses have gone down. You can see the interest rates. Same thing here. You can see it again. Same thing here. You can see it again. So let's just count. We have 1, 2, 3, 4 months to get to that point. Then on the 5th month is 5, 6, 7, 8 months. And here we are on the beginning of month number 9, right? And on month number 9, what's happening? We're doing the same rinse and repeat cycle. But on month number 9, once month number 9 is over, there's $4,158.83 as a balance to the personal line of credit. But look at what we're able to do at the beginning of month number 9. We're able to finish off this Discover card because it started at $5,600, and here we are 9 months later making $150 payments. I'm going to estimate high and say that she'll probably have an additional $4,500 still left on that Discover card that will actually move it over into the personal line of credit, and we're going to stay under the 9,900 target. That's the strategy. That's efficiency. You're not going over. You're not using too little. You are staying right at our target, which is 9,900. When we make that change, you can see it's now $8,658, right? We already know the drill. Rinse and repeat. But so you can see the numbers. 3,275 is going in. Here's the exciting piece again, because if prior to that happening, our cash flow was $1,013.31. The fact that she no longer has to make a $150 payment to that Discover card, that means our cash flow is going up. So now our cash flow is increased to $1,163.31. You guessed it. That means that also her expenses is going down by the same dollar amount, right? So that means $150 to her expenses is being removed. So instead of the old dollar amount of expenses, $2,261, her new expenses now is $2,111.69. This is beautiful. This is wonderful. So we're going to rinse and repeat, right? I'm not making this up, folks. It's all there. I calculated the payments. I calculated the balances. I calculated the interest that you'll be charged at 9% on a personal line of credit. And lo and behold, we are going to do rinse and repeat all over again. So I know the question that you're asking is, how long does this whole process take rather? Well, if you did it this way, if you went and got a loan, you're probably looking at a loan for 4 or 5 years. Well, by leveraging a line of credit, by staying at the right number, 66% of the line of credit, right? By putting in your income that is counted as payments throughout the course of the month and merely taking out for living expenses when you need it, that means that in 16 months, by the end of month number 5, the balance coming into the next month is $1,949.29. And if you have $3,275 in income that's coming in, that income is more than enough to pay off completely that balance in a matter of 16 months. So not only did I show you which card to pay off first using the CFI method, but I actually showed you how it's going to impact your finances and how it looks for you when you take on the task of paying off your credit card and leveraging this rapid payoff method that is shown is specifically for this particular goal. So I really hope this helps you. Again, continue to share, like, subscribe, share this with all your friends and families. The holidays are coming up. What that means is a lot of people incur some additional debt. Then they start off the new year and they make New Year's resolutions to get out of debt, and they just don't know how. So if this has been helpful to you, or you know someone that this will be helpful for, share this to them. If you need more help and a partner to partner up with you to help you get this done, my calendar is below. Let's set up a time for a free call consultation. I'll be more than happy to do that for you. So on to the next video. Take care and God bless.